I discovered a wealth building strategy so simple yet robust that I decided to start a YouTube channel documenting the journey and the process. I'm sharing this strategy for entertainment purposes only. I'm not a financial advisor, and none of this should be taken as financial advice. Today, I am introducing the Arbitrage Flywheel. A few weeks ago, I came to the realization I could borrow money with a margin loan at a rate lower than the amount of return I expect to earn. This creates an arbitrage. But what is an arbitrage? Let's dig in. Arbitrage is the simultaneous buying and selling of securities, currency, or commodities in different markets or in derivative forms in order to take advantage of differing prices for the same asset. So here's an easy to understand example. Imagine Apple stock is trading for 200 in New York, and on the London Stock Exchange, it's trading for 201. You could purchase one share of Apple in New York for 200 and simultaneously sell that same share in London for 201, and you would pocket a risk-free dollar. The spread is all profit. Arbitrage opportunities, if you can find them, they're pretty much risk-free income. People find arbitrage opportunities in retail stores, sports betting, and the Forex markets. Now, they aren't easy to find as asset valuations and markets these days are very efficient. So the arbitrage that I have created is a margin arbitrage, and let's dive in. In my situation, I am arbitraging the difference between what a dollar costs to acquire versus what it could potentially return. The spread or difference is my profit. Here's how that works. My broker offers margin loans at 5.25%. I take a loan, I purchase assets with margin that have historically returned above 5.25%. Every basis point above 5.25% that I earn on those assets is all profit. Over time, equity is created as assets grow in value. But this is just the first step of the flywheel. So here's how the flywheel works. I designate a portion of my account to funds that generate dividends. The dividends I earn are used to pay the interest on the loan, pay down the loan, and buy more assets. I want you to think about that concept and its potential. I'm getting a loan to purchase assets, and those assets pay for the loan. I don't have to pay interest, the funds do. I don't have to pay off the loan, the funds will. Over time, as asset valuations rise, equity increases and the flywheel speeds up. As equity increases, we can borrow more assets and more funds that are going to, again, pay for themselves, pay down the loan, and generate long-term wealth. This is not a short-term strategy. The flywheel is going to start slowly, but over time, the compounding effect will speed up and true long-term wealth can be created. Now, this is not without risks. Investing is risky and using margin is even riskier. There are many things that could go wrong, and I could get margin called and lose it all. In future videos, I'll discuss how to mitigate those risks and set myself up for success in the future. I'll be giving detailed breakdowns on the strategy, market updates, letting you know why I choose the funds I do, and answer all of your questions. Thanks for watching. If you have any questions on the strategy, drop them below and I'll respond. Don't forget to like and subscribe. Talk to you soon.